Maybe one day, investors will look back on 2025 and call it the Great Silver Run. Silver's parabolic move this year has pushed spot prices to more than double where they stood just 12 months ago. With gains like that, analysts naturally start looking for signs of exhaustion, a blow-off top, a breakdown in momentum, signals that the rally is nearing its end. But despite silver's rapid climb, those classic warning signs simply aren't there. Instead of exhaustion, we're seeing consolidation and confirmation, checkpoints along the way as bullish momentum carries precious metals into uncharted territory, and that has important implications for what could come next in 2026. If you value expert insights and stories on precious metals no one else tells, please subscribe. This is the best way to support the channel. Thank you. What goes up must come down. It's a phrase applied to everything from roller coasters to investments. But while all markets experience volatility, not everything ultimately reverses. Gold once traded at $35 an ounce, and it has never returned to those levels. Historically, however, silver has behaved differently. In past cycles, parabolic moves in silver have often marked the end of precious metals bull markets, not the beginning. In 1980, silver reached an all-time high just shy of $50 an ounce. Within weeks, prices collapsed. The party was over. The pattern repeated in 2011. After a decade-long bull market, silver's intraday high near $49 coincided with the peak. Prices unwound and ultimately entered a prolonged bear market, trading between $15 and $18 an ounce until the global disruptions of 2020 reset the landscape. This time feels different. Silver has surpassed every prior rally, setting new all-time highs near $65 an ounce. And yet, the usual signals that mark the end of a bull market are notably absent. If you let data tell the story, we are, somewhat surprisingly, still in the middle of a multi-year bull run. When analysts talk about exhaustion or a blow-off top, they are looking for specific tells that signal a potential reversal. Price action matters, but it is only one piece of the puzzle. A near vertical rise over a short period, a rapid collapse in the gold to silver ratio, a surge in retail-driven ETF flows, and aggressive new leveraged positions in the futures market are the kinds of signals analysts layer together to assess whether a market is nearing its peak. Silver's price action over the past month has been decisive, with spot prices rising between 20 and 30%. Moves like that would normally raise concerns that a rally is nearing its end, but so far the data does not support that conclusion. In the futures market, open interest has actually declined slightly heading into the most recent leg higher. That matters because blow-off tops are typically fueled by a surge in speculative leverage. This time we're not seeing traders pile in the way they have at the finale of past rallies. The commitment of traders reports tell a similar story. There's a clear bullish skew, with managed money holding net long positions and commercials net short, but positioning has not reached the extreme levels that preceded sharp reversals in previous cycles. The gold to silver ratio has also moved sharply lower, falling from above 100 earlier this year to below 70. While that drop is notable, it is not historically extreme. Prior to 2014, the ratio frequently traded between 50 and 70. By comparison, it collapsed to nearly 30-1 at the 2011 peak and to a record low of 17-1 during the 1980 silver spike. Options activity in popular ETFs like SLV is increasing with higher volume and participation. But what we are seeing looks consistent with strong momentum, not the kind of speculative frenzy or short-dated gambling that typically marks the terminal phase of a rally. And finally, we have yet to see the classic reversal day that often signals a rally has reached its climax. A bearish reversal day is a well-known technical marker. Typically begins with heavy volume and an attempt to push above the prior day's high, followed by a sharp sell-off that closes below the previous day's close. That intraday shift reflects a sudden flip in sentiment from aggressive buying to broad distribution, and it can act as a bellwether for the final phase of a rally. Now, on its own, a reversal day is not enough. Usually needs to be followed by weak rebounds and sustained selling pressure to confirm exhaustion, but when it happens, it is often the first concrete signal that momentum is beginning to fail. In truth, blow-off tops and the end of bull markets are usually identified in hindsight. But based on the signals we've outlined, the risk of this rally ending in December appears moderate at most. And that assessment is made before factoring in the fundamentals that brought us here in the first place. Persistent multi-year supply deficits driven by chronic underinvestment in silver mining have created structural shortages in parts of the global market. Fragmented inventories are contributing to regional premiums and arbitrage opportunities, while declining interest rates and a weaker US dollar continue to support the investment case for silver. Add to that strong and growing industrial demand, which consumes vast quantities of silver each year with limited recycling potential, and the picture that emerges is not one of a market at the end of its run, but one that appears to be somewhere in the middle of its current cycle. And if this rally is not over, then 2026 still carries meaningful upside potential. That said, a continuation of silver's parabolic move would likely accelerate the timeline toward a late cycle phase. Healthier bull markets tend to advance in stages, pausing, consolidating, then moving higher in a stair-step pattern. That kind of price action builds confidence that higher levels are being accepted by the market rather than chased. It also allows key trend indicators like the 50 and 200-day moving averages to catch up to price. When prices run too far ahead of these longer-term averages, risk increases. Traders begin trimming positions, momentum slows, and sustaining further gains becomes more difficult. In contrast, measured advances tend to extend bull markets rather than exhaust them. When we look beyond how far silver has already moved and focus on what would keep prices elevated and sustainable, periodic pullbacks are not only likely, they're healthy. The average price of silver in 2026 could easily sit below current highs without invalidating the broader trend. We saw a clear example of this in late 2025. After trading near $54 in mid-October, silver pulled back and consolidated between $47 and $50 for several weeks before retesting prior highs in mid-November. Volatility following a rapid advance should be expected. Silver has now more than doubled over the past year. A repeat of that kind of performance is not impossible, but it would significantly raise the risk that the rally ends sooner rather than later. If silver were to surge again at that pace, the probability of a premature peak would likely move from moderate to high. By contrast, a more measured advance on the order of 25% from current levels and 2025 average prices would be consistent with recent historical behavior. Under that scenario, a move toward $80 per troy ounce in 2026 becomes plausible. And if silver continues to outperform expectations, as it has this year, even triple-digit prices cannot be ruled out before the bull market ultimately enters its final stages. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.